If you saw an asset down over 78% in a single year, flashing strong sell signals across the board, would you call it a falling knife to avoid? Or secretly wonder if it's, wildly undervalued?
Oh, man. It's the ultimate test of investor psychology, right?
Yeah.
Because staring at a chart that looks like a literal cliff dive always triggers that quiet, kind of greedy voice in the back of your head asking, wait, what if I catch the exact bottom?
Right. It is so tempting. But listen, before we unpack this, you need to hit that like button, subscribe to our YouTube channel, and we are making it absolutely compulsory for you to leave your comments and feedback below.
Yeah, we want to know where you stand on this.
Exactly. Are you brave enough to catch a falling knife, or do you stay far away from trades like this? Drop your thoughts. Because today's deep dive is zeroing in on a highly specific, fiercely debated financial instrument. We're looking at the GraniteShares 2x short NVDA Daily ETF.
Ticker symbol NVD.
That's the one. And our mission today is to tear into the underlying market data, demystify the actual mechanics of leveraged inverse ETFs, and honestly, figure out exactly what the sources are telling us about this high-risk asset.
And just to set the ground rules right out of the gate here, everything we're discussing today is strictly an educational exploration of the provided data.
Yeah, absolutely no financial advice is being given.
None. We are just breaking down the mathematical structure and the historical performance of this ETF.
We are just reading the blueprints. And, if we really want to understand why the price of NVD has been plunging, we first need to understand what this ETF actually is, because it emphatically does not function like a normal company.
Not even close.
Right? Like normally when I'm evaluating a stock, I'm looking for the foundational building blocks. I want to see quarterly or annual income statements.
Yeah, the basics.
Yeah, I want to look at a balance sheet. I want to trace the cash flows so I can know what the company actually manufactures and what they spend. But looking at the sources for NVD, there isn't a traditional income statement.
Nope.
There are no factories, there's no software. So what exactly is a buyer actually purchasing here?
Well, you are purchasing a highly complex mathematical equation, basically wrapped up in a tradable ticker. You aren't buying a piece of a business that creates physical products or services. NVD is an exchange-traded fund, but its quote-unquote revenue doesn't come from selling microchips.
Then where does it come from?
It's entirely derived from financial derivatives, specifically swaps and options, along with incredibly heavy cash holdings. Like if you look at the portfolio composition from the latest data, this ETF holds a massive 82.5% of its assets simply sitting in cash.
Wait, hold on. Over 80% of the fund is just cash.
Yeah.
Why would anyone buy an ETF just to have the manager sit on a giant pile of cash?
Because that cash is essentially the collateral required to play a very, very dangerous game. They use the remainder of the assets to purchase derivative contracts from major banks. And the full purpose of those contracts is to achieve a negative 2 times daily inverse leverage on NVIDIA stock.
Okay, let's translate that for a second.
Sure. So if NVIDIA's stock goes down 1% in a single trading day, this ETF is mathematically designed to go up 2% that same exact day.
Okay, so the fund enters into these agreements with banks, these swap agreements, where the bank promises to pay the fund if NVIDIA drops, and the fund has to pay the bank if NVIDIA rises.
Exactly.
So that massive cash buffer is just there to guarantee they can cover the bet if NVIDIA's stock surges and they lose the trade.
Precisely. It is a daily, heavily leveraged bet against literally one of the most volatile tech stocks on the market.
Let's look at the key financial data here. The total net assets, the AUM, is sitting at approximately $88.7 million.
Okay.
But then there is the expense ratio. The filings show a 1.35% expense ratio.
Which is steep. If you look at a standard S&P 500 index fund, you might pay an expense ratio of what, 0.03%?
0.05, yeah.
Right. So why is NVD charging 1.35%? That feels like a failing grade in the ETF space. Well, you have to consider the operational mechanics required to maintain that leverage. Achieving a precise negative 2 times return requires constant daily intervention.
Meaning they're actively trading it.
Exactly. The fund managers can't just buy a stock and go to sleep. They are actively buying, selling, and recalculating swap agreements every single day right before the market closes, just to reset their leverage for the next morning.
That sounds exhausting.
It is. And that level of hyperactive management, combined with the premium costs of the derivative contracts themselves, because the banks charge for those, it's expensive. So they pass that operational cost directly onto the buyer through that 1.35% fee.
Man, that is a massive headwind for any potential profits. You are bleeding over 1% just to keep the lights on.
Yeah, it eats into everything.
Now, the 52-week range is where the whiplash really sets in for me. The 52-week high was $36.90, and the low is $6.12.
A massive drop.
But looking through the distribution history, our sources highlight a very strange anomaly. NVD paid out a dividend.
Right.
They distributed 85 cents per share on December 29th, 2025. And because the share price has collapsed so dramatically since then, that gives it a trailing dividend yield of roughly 13.1%.
Which looks crazy on paper.
It does. I mean, a 13.1% yield on an asset down over 78% feels like finding a $20 bill taped to a falling anvil.
Yeah.
Are people getting distracted by that yield?
They absolutely are, and it is a classic financial mirage. You have to remember how yield is actually calculated, right? It's the annual dividend payout divided by the current share price.
Okay, so it's a ratio.
Exactly.
Yeah.
That yield looks incredibly juicy only because the denominator, the share price, has basically fallen off a cliff. That 85-cent dividend was paid when the fund's price was significantly higher.
Oh, I see.
So investors who use automated screeners, to search for high-yield dividend stocks, they might stumble onto NVD, see that double-digit percentage, and mistakenly think they found an incredible income-generating asset.
But the capital depreciation completely wipes out the value of the dividend. You get your 85 cents, but you lose $30 in share value.
Right. The falling anvil crushes the $20 bill. The dividend is largely just a byproduct of the cash holdings generating interest anyway, but it's entirely irrelevant when the underlying asset is eroding that quickly.
So if this ETF is mathematically designed to bleed cash through high fees and daily leverage resets, I have to imagine the actual price chart looks like a horror movie. What is the technical market data telling us right now?
It's definitely grim. As of our data cutoff yesterday, April 14, 2026, the price is sitting at just $5.99. The trend direction is aggressively bearish. We are looking at a negative 78.2% return over the last year. And if we look at the moving averages, the 50-day moving average is currently at $7.15.
Okay. And just for those who might not trade technicals every day, the 50-day moving average is essentially just the average closing price over the last 50 days. It's used to smooth out daily volatility and spot a trend.
Exactly.
So since the current price of $5.99 is sitting significantly below that $7.15 average, it cements the reality that the downward momentum is still fully in control.
And the momentum indicators really reinforce that weakness. The technical data specifically highlights the RSI and MACD indicators.
Let's break those down. Don't just throw the acronyms at me. What is the RSI actually telling a trader?
Fair enough. RSI stands for Relative Strength Index. It measures the speed and change of price movements on a scale of 0 to 100, basically to determine if an asset is overbought or oversold.
Okay.
Even with the massive drop in price, the RSI isn't showing a healthy stabilization. It's showing extreme sustained weakness.
And the MACD.
The MACD, the moving average divergence, that looks at the relationship between two different moving averages to spot trend changes. And right now, the MACD is signaling that the downward momentum is actually accelerating, not slowing down. Literally everything on the dashboard is currently flashing a strong sell.
But despite all of those red flashing lights, the volume is staggering. The market data shows a 65-day average trading volume of 75.1 million shares.
It's incredibly liquid.
Yeah, people are actively buying and selling this constantly throughout the day. Which leads me to a really big question. In technical analysis, we usually look for support, a theoretical price floor where buyers step in because they believe the asset has finally become too cheap to pass up.
Right.
But our sources point out that NVD has no firm fundamental support. Why is there no floor here?
This brings up a really critical misunderstanding about how we fundamentally value assets. Traditional support levels exist because investors believe a company's underlying earnings, its physical assets, or its future growth prospects justify a certain minimum price.
Like if Apple drops too far, value investors swoop in.
Exactly. But NVD doesn't have earnings. It doesn't have a product. Analyst ratings like buy or hold apply to the underlying stock, which is NVIDIA, not to this derivative ETF.
So because of the daily reset nature of leveraged ETFs, it simply cannot have a fundamental floor. Its price today is purely a mathematical reaction to what NVIDIA did today, completely disconnected from what the ETF was priced at a week, a month, or a year ago.
Correct. It is totally untethered from fundamental value.
But human psychology doesn't like that. Because there is no fundamental floor and the price is sitting at roughly $6 compared to its $37 high, it forces a massive debate in the retail investing community.
Oh, a huge debate.
Right. Like, is this a wildly undervalued gem waiting to snap back? Or is it the ultimate value trap? Because when a price drops that violently, our brains just scream, discount. It is the quintessential buy the dip mentality.
And our sources warn that this is absolutely a trap.
Right.
It is perhaps the most dangerous retail trap in modern finance, and it all comes down to two insidious mathematical concepts: volatility decay and compounding risk. As we established, leveraged inverse ETFs are pure math. They are not investments in a company's future.
Okay, I want to slow down here because this is the core of the whole issue. Explain the math of volatility decay to me. Walk me through exactly how a retail trader gets wiped out, even if they guess the market direction correctly over a few days.
All right, let's use some really clean numbers to make it easy. Let's say NVIDIA's stock is currently priced at exactly $100.
Okay, starting at 100.
And let's say our NVD ETF is also priced at $100.
Got it.
So on Monday, NVIDIA has a bad day and drops 10%. It goes from $100 down to $90.
Which means because NVD is a negative 2 times daily leveraged fund, it goes up 20%.
Exactly. So your ETF goes from $100 up to $120. You're feeling like a genius.
Great. I made 20 bucks. I should sell.
But you decide to hold it overnight instead.
Big mistake.
Yep, because on Tuesday, NVIDIA bounces back. It gains 11.1% to go from $90 exactly back to $100.
Okay, so NVIDIA is back to exactly where it started.
Right. But remember, your EPF has to do the exact opposite of NVIDIA's daily percentage move times 2.
Uh-oh.
So if NVIDIA went up 11.1% on Tuesday, your ETF must drop 22.2% from its new Tuesday morning starting price of $120.
Wait, let me do that math. A 22.2% drop on $120. That's a loss of roughly $26.64. So my ETF drops to $93.36.
Exactly. Look at what just happened. NVIDIA's stock price ended up completely flat after 2 days of bouncing around, starting at 100 and ending at 100. But your NVD ETF lost over 6% of its total value.
Oh.
That is volatility decay.
That is wild.
Yeah.
So even if the underlying stock just trades sideways in a volatile, choppy pattern, the daily compounding math forces the leveraged ETF to just slowly bleed value.
Yeah, imagine you're trying to walk up a down escalator. If you sprint, meaning NVIDIA drops sharply and consistently day after day, you might make massive progress and profit.
Right?
But if you stand still, if NVIDIA's stock just bounces around flatly, the escalator of daily leverage resets is going to pull you steadily backward to the bottom floor. The mathematical design of the fund guarantees that holding this for more than 1 day means your returns will start to drift significantly from the intended negative 200% of NVIDIA's long-term performance.
And this is exactly why retail traders get trapped. They treat an ETF like NVD as a traditional stock to hold. They buy it at $15, it drops to $6, and they say, I'll just hold it until it recovers.
Yeah, it never does.
Because the math dictates that a recovery to past highs becomes exponentially harder to achieve every single day because of that escalator pulling them down.
And beyond the compounding risk of the escalator, there is an entirely separate danger that the sources point out: counterparty risk.
Oh, right, from the banks.
Exactly. Remember that 82.5% cash pile we discussed? NVD uses that to enter into those swap agreements with large financial institutions. When you buy this ETF, you aren't just betting against NVIDIA. You are implicitly taking on the credit risk of the banks on the other side of those derivative contracts.
Meaning if there is a massive shock to the financial system, like a black swan event where major banking institutions face liquidity crises or default, they might not be able to honor the payout of the swap agreement.
Precisely. You could be perfectly right about NVIDIA crashing. But if the bank providing the swap defaults, the ETF cannot collect the returns. Your exposure isn't isolated just to the semiconductor sector. It's totally entangled with the stability of the institutional banks providing the leverage.
That is a terrifying layer of hidden risk that I guarantee most retail traders aren't thinking about when they click buy on their brokerage app.
No, they're just looking at the ticker symbol.
Right. So if the mechanics are a mathematical trap for long-term holders and you are taking on hidden banking risks, we have to address the elephant in the room.
The volume.
The volume. Why are 75 million shares trading hands every single day? Who is stepping into this arena, and what is the actual bull case for taking this trade?
The massive volume really comes down to extreme short-term conviction. The bull case for holding NVD, which, to be clear, means you are highly bearish on NVIDIA's immediate future, is that you are trying to capture a violent, sudden shock to the downside. Day traders and institutional hedgers use this to profit from immediate catalysts.
What kind of catalysts justify stepping in front of this thing?
A surprise earnings miss is the most obvious one.
Sure.
NVIDIA has set such astronomical expectations for revenue and growth that any slight deviation, even a minor slowdown in forward guidance, could cause a sudden, sharp drop in the stock price.
What else?
You also have geopolitical and regulatory headwinds. Market analysts frequently point out the potential for sudden AI export bans. If the government abruptly restricts NVIDIA from selling its most advanced data center chips to highly lucrative overseas markets, the stock would react instantly.
So headline risks?
Exactly. Or simply a sudden, broad tech sector correction triggered by macroeconomic data, like an inflation spike. If you believe any of those specific things are going to happen tomorrow, NVD is the high-octane tool you use today to profit heavily from it.
Okay, I understand the mechanics of using it as a highly specific hedge against a bad news cycle. But the bear case against holding NVD, meaning the argument that NVIDIA is going to just keep winning, is incredibly intimidating.
It really is.
Look at the financial filings. NVIDIA is an absolute powerhouse. In fiscal year 2026, NVIDIA posted record revenue of $215.90 billion, driven almost entirely by their absolute stranglehold on AI and data centers. Getting against a company generating $215 billion in revenue just because the stock price, quote-unquote, feels too high is terrifying. You're basically standing on the tracks playing chicken with a freight train.
And you really have to understand the sheer momentum of that freight train. NVIDIA isn't just selling a speculative software product that might go out of style. They are selling the foundational physical infrastructure for the entire global artificial intelligence boom.
The hardware.
Exactly. Tech giants and data centers around the world are fundamentally reliant on their hardware to train their models. When you buy NVD, you are betting that this multi-billion-dollar paradigm-shifting momentum is going to suddenly reverse.
And not just that it will reverse eventually, but that you need it to reverse exactly on the Tuesday that you happen to hold the ETF before the volatility decay eats your capital.
It's exactly right. Reconciling these huge risks with the massive 75 million daily trading volume really forces us to look at the timeline. Time is the ultimate enemy of this specific asset.
Let's compare the two distinct outlooks from our sources, the short-term outlook versus the long-term outlook.
So the short-term outlook depends entirely on immediate day-to-day NVIDIA price action. Any rally in NVIDIA causes sharp, 2 times amplified losses for NVD. But if NVIDIA drops sharply today, NVD pays out handsomely today.
Because it's a day trading tool.
Precisely. It is designed to be a day trading tool. You are meant to be in and out before the closing bell.
And the long-term outlook, what happens to the trader who buys this and just forgets about it for a year?
The long-term outlook is mathematically disastrous. Due to the daily compounding of returns we walk through, the natural volatility of the underlying tech stock, and those incredibly high 1.35% management fees constantly eroding the capital. Leverage inverse ETFs are mathematically expected to trend towards zero over long periods.
Literally trend towards zero.
Yes. It is not a matter of if, but when. Unless the underlying stock NVIDIA goes into a permanent, uninterrupted daily freefall with absolutely zero bounce backs.
So synthesizing everything we've looked at today, this isn't a buy and hold investment asset. It's a scalpel. You use it in the operating room for a highly precise, quick market cut, and the second the surgery is over, you put it away.
Right.
Because if you leave a scalpel sitting around in your pocket, you're going to severely hurt yourself.
That is the perfect analogy. A scalpel in the hands of a skilled day trader executing a highly specific, fundamentally timed strategy can be incredibly effective. But a scalpel in the hands of a long-term investor looking for a place to park their retirement money is insanely dangerous. It's crucial to separate the fundamental valuation of a traditional company from the mathematical mechanics of a leveraged derivative product. They operate in completely different
A
realities.
completely different rule book. And that brings us full circle. We started by looking at a chart down over 78% and wondering if it was a value play.
And we know the answer now.
Yeah, by breaking down the swaps, the fees, and the volatility decay, the data emphatically shows it is not. But just as a final reminder to everyone, everything we unpacked today was pure analysis of the market data and the mathematical structure of the ETF, not financial advice.
Always know the math behind what you are buying.
Always. But it leaves us with a fascinating dynamic to watch. With NVIDIA's AI dominance seemingly unshakable right now, pulling in hundreds of billions in revenue, what happens if the AI narrative finally hits a regulatory or developmental speed bump? Is a vehicle like NVD the smartest 24-hour insurance policy on the market, or simply the fastest mathematical way to empty your wallet? Let us know what you think in the comments. We'll see you next time.